Good evening, all. I'm Pooja Rajendra of S2M Finance and Accounting. Today, I'm privileged to welcome you all to the seventh session of UGC Net Coaching class conducted under initiative of Commerce Club, Department of Commerce, University of Kerala. Today, we will be having two sessions. First session is on banking and financial institution, and second is on consumer behavior and logistics management. First session will be taken by Vinu Ashok. He is a research scholar of Commerce Department, University of Kerala. I welcome Vinu sir to give some insights on banking and financial institutions. Sir, please.
Okay, thank you. Thank you for the welcome. Just a minute. I hope the screen is visible.
Yes, sir.
Okay, thank you. And good evening to one and all. I am Mr. Vinu Ashok, doing research and in Department of Commerce, University of Kerala. So I hope that slides are visible. Then for the for the next 1.5 hours, I am going to discuss about some my insights about this my topic, financial institutions. Okay, just going to the slides. Okay, first of all, I would like to introduce about the overview of financial systems, overview of financial systems. Under this financial system in India, classified into then first one, financial assets or financial instruments. It is classified into two types: the short-term instruments like treasury bills, certificate of deposits, and commercial papers, etc. Then another type of financial instrument is long-term financial instruments like shares, debentures, government bonds, etc. So first of all, I would like to introduce about the financial system in India. First one is a financial asset or otherwise known as financial instrument. It may be classified into two types: short-term as well as long-term. The short-term instruments known as money market instruments, known as this treasury bills or T-bills, certificate of deposits, and the commercial papers, etc. The detailed explanation is not necessary. It's an overview only, so that's why. Then long-term instruments are classified into shares, debentures, and government bonds, etc. Then next part of this financial system is our financial markets. Financial markets are classified into money market, that is market meant for short-term security or maturity, in which maturity is less than 1 year. That's money market instrument. Money market. Then next one is capital market. It's an instrument with a maturity of more than 1 year. Long-term instruments are deals with here capital market. So the financial assets are classified into short-term financial assets and long-term financial assets, short-term financial assets and long-term financial assets. The financial markets are classified into money market. That's meant for short-term instrument that with the maturity less than 1 year. And another financial market type of financial market is capital market. That is instruments with a maturity of more than 1 year, or long-term in security or long-term financial securities deal in the market. This capital market. Okay, instruments deal with the instrument with the maturity more than 1 year. Okay, next one is financial institution and financial intermediary. Financial institutions and financial intermediary. That's my topic. Then financial institutions and intermediaries are classified into two broad categories. under organized sector as well as unorganized sector. Organized as well as unorganized sector. So the financial institutions are and intermediaries are classified into two broad categories: organized sectors and unorganized sectors. Under this organized sector, the financial institutions are stock exchanges, different stock exchanges like Bombay Stock Exchange, means NSE, National Stock Exchange, like etc. etc. And non-banking financial institutions, stock exchanges, non-banking financial institutions, then development institutions, non-banking financial institutions, development institutions, and other investment institutions. So once more, the financial institutions and intermediaries are classified into two broad categories: the organized sector as well as unorganized sector. In the organized sector, financial institutions are known as different stock exchanges in India, then non-banking financial institutions, then development institutions and investment institutions. Such institutions come under this unorganized sectors are money lenders, private money lenders, chit funds, and others. So financial institutions and intermediaries are classified into two broad categories: organized sector as well as unorganized sector. Under the category of organized sector, the financial institutions are various stock exchanges in a country, then a non-banking financial corporation or non-banking financial institutions, then development institutions, then investment institutions, and those institutions come under the category of unorganized sectors are money lenders, chit funds, and others. Money lenders, chit funds, and others. Okay. So the overview of Indian financial system or financial system, overview of financial system, the financial assets, financial markets, and the financial institutions. Financial assets are classified into, or financial instruments are two types: short-term instrument or money market instruments, and a long-term instrument or capital market instrument. Short-term instruments are treasury certificate of deposits, and commercial papers, etc., etc., so and so on. Then long-term instruments or long-term financial assets are shares, debentures, government bonds, etc. So the financial markets are classified into broad categories: money market and capital market. Under this capital market, there is also primary market and secondary market is there. Okay, then financial institutions or intermediaries are classified into two broad categories: organized sectors and unorganized sectors. Under this organized sectors, different stock exchanges in a country, non-banking financial institutions, development institutions, and investment institutions are there. Under the category of this unorganized sector, there are money lenders, chit funds, and others. Money lenders, chit funds, and others. So come to the point: financial institution. Financial institution and its classification. Financial institutions are known as financial intermediaries or financial market participants. There are different participants in financial markets that facilitate the capitalization of funds or capitalization of savings or capitalization of these amounts in a country. Okay, the financial institutions are classified into four categories. Then development financial institutions, non-banking financial institutions, mutual funds, and pension funds. The financial institutions are classified into four broad categories: development financial institutions, non-banking financial companies or non-banking financial institutions, mutual funds, and as well as this pension funds. Okay, these are financial institutions. So what do you mean by this development financial institutions? So the first category is development financial institutions. So what do you mean by this development financial institution? Or it is otherwise known as development bank. So development financial institutions are also known as these development banks, and these are financial agencies. These are financial agencies. Their purpose or they are engaging in the promotion and development of industry. They are engaged in the promotion and development of industry, agriculture, and other important areas. So the development of the infrastructure or the development of agriculture and industry is the main purpose of this development of financial institutions. So these are the financial agencies engaged in the promotion and the development of industry, agriculture, and other important areas. So there are national as well as regional institutions for the development of this industry as well as industry and agriculture sector, etc. So these development financial institutions are financial agencies that helps in the promotion and development of industry, agriculture, and other key sectors. And they provide a medium. These institutions provide a medium and a long-term capital for a productive investment, a medium and a long-term capital for a productive investment, and it helps in or it aids in the accelerated growth of an economy. It aids or it helps in the accelerated growth of an economy, and it allocates resources. It allocates resources to high priority areas, and it also provides housing, small scale industries, also provide financial assistance to housing, small scale industries and infrastructure. So this is the overview of this development financial institution. Detailed theory is not possible for this. Detailed theory is not necessary because it's an objective type question. So that's why some points we have to understand. So the development financial institutions are financial agencies. They are financial agencies. Their purpose, or they are engaged in the activities, or they are engaged in the promotion and development of industry, agriculture, and other important areas. So for that, they provide medium and long-term capital for this productive investment or businesses, and it helps or it aids in the accelerated growth of an economy, and it allocates resources to high priority areas, and it also provides financial facilities or financial arrangements for housing, small-scale industries, and other infrastructure facilities. So this is the purpose of this development financial institution. So this is the purpose of this development financial institution. So the development financial institutions are those financial agencies helps in the promotion and development of industry, agriculture, and other key sectors or important areas. Then they provide a medium as well as long-term capital for this productive investment, and it helps or it aids in the accelerated growth of an economy. It aids in the accelerated growth of an economy, and it also helps to allocate resources in high priority areas where the resources are scarce, and it also provides financial facilities or financial help for this housing, small scale industries, and infrastructure facilities. So the following are the different development financial institutions in India. The first one is, the most important one is IDBI, Industrial Development Bank of India. It is known as IDBI, Industrial Development Bank of India. Its main purpose is to promote the accelerated growth in an economy, and it started its operations in 1st July 1964. So it started in 1st July 1964. So its main purpose is to promote industrial growth or accelerate industrial growth, and it made a public issue, which was the largest issue at that time during this 1995. In July 1995, Industrial Development Bank of India made a public issue, which was the largest issue in that period, and it provided. Hello. Okay. And it provided a merchant banking facility. It provided a merchant banking facility. What do you mean by this merchant banking facility? Those facilities. So what do you mean by this merchant banking facility? Merchant banking facility means underwriting, then loan services, financial advisory services, etc. These are known as merchant banking facilities. And also it provide forex services or this foreign exchange services and facility in foreign exchange loans, etc. to the importing and exporting houses. So this institution is known as Industrial Development Bank of India. It started its operations in 1st July 1964, 1st July 1964, and for promoting this industrial growth. And in July 1995, IDBI made a public issue. It was the largest one, and it provide various facilities like merchant banking facility. So it's a merchant banking facility is a combination of banking as well as consultancy services, and it provides to consultant service to financial, marketing, and managerial areas related to this business. And it also provides forex services or foreign exchange services, namely spot and forward purchase of currencies, and helps in foreign businesses like letter of credit facilities, letter of credit and debt servicing, then swaps, forwards, etc. These are the helps provided by this Industrial Development Bank of India. So the Development Bank of India, the first most important development financial institution is Industrial Development Bank of India, and it started its operation. It started its operation during this 1st July 1964. It helps to promote the industrial growth or accelerate the industrial growth in an economy or in a country. And it will also provide merchant banking facilities. It also provide merchant banking facilities and also forex services. Merchant banking facilities and also forex services. Okay. So The another one is Industrial Finance Corporation of India. The previous one was Industrial Development Bank of India, or IDBI. Now it's another institution is there, Industrial Finance Corporation of India, Industrial Finance Corporation of India, or IFCA. So IFCA, or Industrial Financial Corporation of India, started its operation on 1st July 1948, and 1st July 1948, and it provides financial assistance to large scale industries all over the country. It provides financial assistance to large scale industries all over the country, and it provide loans and advances for subscribing to debentures, and it helps in underwriting the issue of industrial securities, then guaranteeing, acting as the guarantee or guaranteeing the deferred payments, and working as an agent of the central government. Also, provide guidance to new, tiny, small scale, and medium scale entrepreneurs or enterprises. So, Industrial Financial Corporation of India started this operation in 1st July 1948. It provided financial assistance to large scale industries all over the country. And it helps in the various functions are underwriting the issue of industrial securities and subscribing directly to shares and debentures of public limited companies. And it also provides helps or guidance to new startups or new, tiny, as well as small scale and medium scale enterprises. So the second important development financial institution is this Industrial Financial Finance Corporation of India, Industrial Finance Corporation of India. It was established on 1st July 1948 under the Industrial Financial Corporation Act, Industrial Financial Corporation Act 1948, and it provide financial assistance, maybe medium term and long term financial assistance to large scale industries all over the country. And the various functions of various important functions of this Industrial Financial Corporation of India were underwriting the issue of industrial securities, then subscribing directly to the shares and debentures of public limited companies, and it provided guidance to new, tiny, and small scale as well as medium scale enterprise. So another form of development of financial institutions are state level financial institutions, state level financial institutions. The state level financial institutions are known as, otherwise state financial corporations. The state level institutions are there. The various financial institutions comes under this state level institutions are SFC, state financial corporations, state financial corporations. Corporations are state level financial institutions. State financial corporations are state level financial institutions which play an important role in the development of this small as well as medium enterprises in a particular state. So its purpose is to encourage or help small and medium scale enterprises in a particular state. And it started its operations in 28th September 1951. 28th September 1951. The various services provided by the state financial corporations are industry research and information services, legal advisory services, then guarantee to loans taken by industrial units from commercial banks, then underwrite the issue of shares, bonds, and debentures, and they provide loans in foreign currencies. So the state level financial institutions are there, known as state financial corporations. It started its operations in 28th September 1951. And its purpose is to provide financial assistance or short-term and medium-term loan financial assistance to industries in a particular state. Okay. Yeah. Also, they provide industry research and information services. They provide legal and advisory services, underwriting of the issue of shares and bonds. Then give guarantee for loans, underwrite the issue of shares and debentures, as well as they provide loans in foreign currencies. Okay, they provide loans in foreign currencies. So another state level financial institution is State Industrial Development Corporation, SIDC, State Industrial Development Corporation. It it started its operations under the Companies Act 1956. 1956, and it is a wholly owned undertakings of state governments. Different state governments are there. It's a wholly owned undertaking of state governments. and its purpose is to promote the industrial growth in the respective state, not a country, in a respective state, in order to provide or in order to promote this industrial development in respective states. Then and also providing financial assistance to small enterprises, and conducting market surveys, then collaborating with the private industries in the state, and also provide also act as the intermediary between this IDBI and as well as the enterprises, as they provide seed capital assistance. They provide seed capital assistance. So the name of the institution is State Industrial Development Corporation. It enacted or established under the Companies Act 1956, and it is a wholly owned undertaking of different undertakings of state governments. And its aim or its purpose is to promote industrial development in a particular state, and also they provide financial assistance or funded assistance to small enterprises. They conduct market surveys about business opportunities. Then they collaborate with private industries in the state, and they provide seed capital assistance, IDBAs, seed capital assistance. So, seed capital assistance is provided by IDBI, and the State Industrial Development Corporation implement these IDBA's schemes for schemes of this seed capital assistance in the particular state. So, just revising, the development of financial institutions are first one, Industrial Development Bank of India or IDBI. It started its operations during in 1st July 1964. Its main purpose is to promote the industrial growth or accelerate the industrial growth in the country. And in July 1995, IDBI made a public issue, which was the largest issue during that time. And they provide merchant banking facility as well as forex services. Then another one is Industrial Financial Corporation of Financial Finance Corporation of India or IFCI. It started in 1st July 1948. Their purpose is to provide financial assistance to large scale industries. The financial assistance may be medium term as well as short term assistance to large scale industries all over the country. Their purpose is to underwrite, their purposes or functions is to underwrite the issue of industrial securities. They subscribe directly to the shares and debentures of a publicly limited company, and they provide assistance or guidance to startups, then tiny, small, medium scale enterprises. Then okay, the another one is State Financial Corporation. It started this operation in 28th September 1951. They provide industry research and information services, are also provide legal advisory services. They gave guarantee for loans and also underwrite the issue of shares and debentures, and then they provide loans in foreign exchange or foreign exchange loans. So another one is State Industrial Development Corporation under the category of state level institution. It is established under the Companies Act 1956, and it is a wholly owned undertaking of state governments. And its purpose is to promote the industrial development in the respective states. They also provide financial assistance to small enterprises. They conduct market surveys. And they collaborate with the private industries in the state, and also it implements IDBA scheme of seed capital in the particular state. Okay. So another one is UTI, Unit Trust of India. Unit Trust of India, actually it is popularized for mutual funds. Okay, Unit Trust of India. So the formation of Unit Trust of India was on 1st February 1963. So it started its operations in 1st February 1963 under the Act of Unit Trust of India Act. Unit Trust of India Act. Then the first scheme of this Unit Trust of India was known as Unit Scheme 1964. The short form is US64. Unit Scheme 1964. It was the first scheme which attracted a large number of investors, and this institution is set up by the Reserve Bank of India. And the main purpose of UTI is to encourage small savings from these customers or savers and investors. and they cover small savings into industrial finance. They collect small savings because the small investors cannot go to stock market directly. So UTI collects, Unit Trust of India collects small savings from different customers, different peoples, and they invest these securities, these savings into industrial securities or industry finance. So Unit Trust of India started its operations in 1st February 1963, and their first scheme, known as Unit Trust Scheme 1964. The short form is US 64, and it is set up by the Reserve Bank of India. It encourages the savings. It covers the small savings into industrial finance. They encourage the savings of lower and middle class people, to give them an opportunity to share the benefits of industrialists in the country, and also it provides liquidity to different units. Units means different customers. Okay, so Unit Trust India started its operations in the 1st February 1963. The first scheme was known as Unit Trust Scheme 1964. It was set up by the Reserve Bank of India. The main purposes are to encourage the savings of lower and middle class peoples, to cover this or convert the small savings into industrial finance, to sell units to investors in different parts of the country, and also provide the opportunity to share the benefits of this industrialization in the country. Okay, so it's known as Unit Trust of India. So another one of most important financial institution is SIDBI, Small Industrial Development Bank of India. Small Industrial Development Bank of India. Then it started its operations in 2nd April 1990. It started its operations in 2nd April 1990, April 2nd 1990. It is a wholly owned subsidiary of Industrial Development Bank of India. So it is a wholly owned subsidiary of Industrial Development Bank of India, and it is a apex institution or a principal financial institution for the promotion, financing, and development of MSME sector. The most financial facilities are provided to the MSME sector and SIC industries, and they provide different services like leasing, factoring, etc. And they also helps in the technological upgradation and modernization of existing and SIC industrial units. So, Small Industrial Development Bank of India started its operations in 2nd April 1990, and it is a wholly owned subsidiary of Industrial Development Bank of India. It is an apex institution for the promotion, financing, and development of these MSME sectors. And they also provide financial facilities to SIC industrial units. They provide a service like leasing, then factoring, and they provide technical upgradation and modernization of. They help in the technological upgradation and the modernization of these existing SIC industrial units. So another one is IDFC, Infrastructure Development Finance Company. As the name suggests, it helps in the infrastructure facility. It provides financial assistance for the infrastructural facilities. So that's why it is known as Infrastructure Development Finance Company, IDFC. So it has started its operations it incorporated on 30th January 1997. Their main purpose is to provide assistance to infrastructural projects or infrastructure projects like telecom industries, power, roads, port, railways, etc., etc. It is also the apex institution for the promotion and financing and development of MSME sectors, and also it is helping in the mid-cap companies. Mid-cap companies. What do you mean by this mid-cap companies? According to this capitalization of a company, classified into three categories: small cap, large cap, and mid cap companies. Its current market price, 20,000 crore or more, it's known as large cap companies, and below 5,000 crore, it is known as small cap companies, and in between these companies, it is known as mid cap companies. Okay, so it helps in the mid cap companies, and it finance projects to help companies to go public through initial public offering. So when a company likes to go to initial public offering, this institution, the IDFC, will provide financial support or this guidance or finance project to help these companies for issuing this initial public offer. So, as the name indicates, Infrastructure Development Finance Company is the apex institution for providing loans to MSME sector as well as investing these infrastructural projects like telecom, power, railways, etc., roadways, etc. And they help in the mid-cap companies to raise funds And they also finance projects to help companies to go public through initial public offerings. So these are development financial institutions. So the development financial institutions are classified into Industrial Development Bank of India, Industrial Financial Corporation of India, then state financial corporations, then state industrial development corporations, Unit of Trust of India, as well as small Industrial Development Bank of India and Infrastructure Development Finance Company. Infrastructure Development Finance Company. So another classification of this financial institution is a non-banking financial corporations or non-banking financial institutions. Non-banking financial corporations or non-banking financial institutions. So these non-banking financial institutions are financial institutions that provide financial services, but not comes under the definition of banks. They not come under the definition of banks, and they have no license of bank license of these commercial banks as like of this commercial bank, and they are financial institutions and provide financial resources or financial services without meeting the legal definition of a bank. This is known as non-banking financial corporations or non-banking finance companies or institutions. These are incorporated under the Companies Act 1956, and various functions of this non-banking financial corporation or institution include this easy availability of loans and the support for economic needs, then mobilization of small savings of the savings, and it helps the borrowers, also mobilization of funds from the savers to the borrowers. And it's a financial institution, and it's also a company. And a non-banking financial institution is a company and which has its principal business the receiving deposit under any scheme and arrangement or in any other matter or lending in any manner. So it comes under the Companies and Companies Act, and these financial institutions provide financial services, different financial services like merchant banking, then venture capital, then insurance, then venture capital for the startup companies, etc., etc. These are the different services provided by the non-banking financial institutions. So these are registered under the or incorporated under the Companies Act 1956. It's a financial institution provide financial services or financial resources without meeting the legal definition of a bank. This is not a bank, so that's why it's known as non-banking financial corporation. And what are the features of these non-banking financial institutions? First one is easy availability of loans. The borrowers can avail loans from these institution very easily and with very few documentation processes. Then they support for economic needs, different needs of the economy. NBFIs provide a loan assistance to several economic needs in a country, and it helps or encourage in the mobilization of funds from the savers and helps the borrowers for the availability of these funds. So this is known as non-banking financial institution. They support for the different economic needs of the society, and the easy availability of loans with minimum documentation and form processing. And these institutions have a very low amount of owned capital. They collect a larger amount from the public, and they are small in size. So these are the features of this non-banking financial corporations. It comes under the Companies Act 1956, and these are financial institutions provide financial resources or financial services without the definition of a bank. And the features of these non-banking financial corporations are easy availability of loans, support for economic needs. It means providing financial assistance to different needs of the or different categories or different sections of the society. That's why it is known as support for economic needs, and it helps in the mobilization of funds from the savers to the borrowers. So this is non-banking financial institutions. So another category of financial institutions are mutual funds, or financial intermediaries are mutual funds. Mutual funds, actually, it is a body corporate registered under the registered with the Securities and Exchange Board of India. They collect small savings from different savers or customers and pool these resources into a portfolio, and they invest or mutual fund agencies invest in different portfolios of large scale companies. So a medium as well as middle as well as small scale savers can't go directly to this stock market. market. So the mutual fund is a collective arrangement. It collects small savings from different savers and invest into large pool of or portfolio of securities offered by these different large scale companies, and the return will be allotted to each savers. Okay. So it's a mutual fund agent. Mutual funds is a body corporate registered with the Securities and Exchange Board of India (SEBI), and it pools savings from or money from individuals or corporate investors and invest the same in a variety of different financial securities or financial instruments. Okay, they pools money or collect savings from small savers and invest the same in different financial instruments. The different mutual fund instruments are equity funds, diversified funds, this is most important, index funds, tax savings funds, then gilt funds, open-ended funds, and closed-ended funds. There are different types of mutual funds are there. First one is equity funds. Equity funds means funds investing in equity shares. The mutual fund agency collect small savings from the savers and invest it into equity shares of large scale companies. It is known as equity funds. Then diversified funds. The investment is made in companies spread across the sector, different sectors of the country. So this is known as diversified funds. And another fund is known as index fund. Index funds are funds invest in the market indices. A popular market indices like S&P CNX Nifty or S&P CNX 500 like this. These are known as index funds. And some mutual funds are meant for tax saving purpose. It is known as tax saving funds. And gilt funds. Gilt funds means government funds, government instruments or government funds. It's known as gilt funds. They invest they invest these resources in the central as well as state government securities. So that's why it is known as gilt funds. Then another one is open-ended and closed-ended. What do you mean by this open-ended and closed-ended? The funds which do not have a fixed date of redemption, it is known as open-ended funds. And closed-ended funds are open initially for entry during the initial public offering and thereafter closing. So that's why it is known as closed-ended funds or closed-ended funds. So equity funds means this collecting the small savings from the savers and invest it into equity shares of the companies. And diversified fund means it invest these securities or these collective savings into diversified portfolios. That's known as diversified funds. And index funds, it invest it invests in the same manner as popular market indices like S&P, CNX Nifty or S&P CNX 500. And some mutual funds are meant for tax saving purpose. It is known as tax saving funds. In some cases, these funds are invested in government, central as well as state government financial institutions or securities. And open-ended funds do not have a fixed date of redemption. And closed-ended funds are open initially, and after this initial public offering, thereafter closed for entry. This is known as closed-ended funds. The advantage of investing in mutual fund is a body corporate controlled by the professional fund managers. So the professional fund management is the salient feature of this mutual fund, and also they spread the risk. And uh, they are targeting these small investors. So these are the features of these mutual funds. So the mutual funds are registered with the SEBI. They pool money from different individual as well as corporate investors and invest the same in different financial instruments. That may be equity funds, diversified funds, index funds, tax saving funds, gilt funds, open-ended, closed-ended funds, etc. The main feature of this mutual fund is they provide professional fund management facilities and also diversification of risk, and also they target the small investors. So these are all about this mutual funds. So another type of funds is pension fund. Pension fund. Actually, pension funds are other types of financial institutions. They manage and administer of personal as well as corporate pension schemes. And the main purpose is to collect regular contribution from individuals, employees as well as employees, And a pension scheme, actually, the purpose is to pool regular contributions from individual or employees and making payments to retired beneficiaries. So I am contributing one of my salary or portion of my salary into this pension funds, and after retiring, I get some beneficial from this pension funds. So though they pool a regular contributions from individual or employees and making payments to retired beneficiaries. There are three types of pension funds are there: employees provident fund, voluntary provident fund, and public provident fund. Okay, employees provident fund scheme, voluntary provident fund scheme, and public provident fund scheme. So what do you mean by this employees provident fund scheme? EPF scheme was introduced to promote retirement savings. Retirement savings, both the employer as well as employee contributing equal amount to this employees provident fund. The another provident fund is a voluntary provident fund. It's a voluntary contribution of each and every individual. And another type of pension fund is public provident fund. Public provident fund, it's a long-term saving instrument to provide income security in retirement years. And public provident fund are under the guidance of this government, central as well as state government institutions. Then so these are all about this pension funds. So the pension, what do you mean by pension fund? Pension fund is a financial institution which specializes in the management and administration of this personal and corporate pension schemes, particularly to retired beneficiaries. So pension funds are meant for these retired hands or retired beneficiaries. There are three types of pension funds are there: employees provident fund, voluntary provident fund, and also public provident fund or PPF. Okay. So that's all about this pension funds. Then another area under this topic comes like this financial sector reform. Financial sector reforms. So what do you mean by this financial sector reforms, particularly in India, financial sector reforms? There is a meaning or operational definition for this financial sector reforms, and it is starting like this. The financial sector reforms aim to increase the soundness and efficiency of financial system as well as promote financial stability and retain public confidence in the financial system. While presenting the budget for the year 2010-11, the then Finance Minister of Government of India announced to constitute a separate commission for strengthening the financial affairs or financial sectors in a particular country or in our country. So that's why they created some reforms for strengthening the financial system, existing financial system, promote financial facility, and also retain public confidence in the financial system. Hello, am I audible?
Yes, sir.
Yeah, okay. So the financial sector reforms meant for strengthening. The main meaning of this financial sector reforms is to strengthen the existing financial system or financial intermediaries or a financial system or financial system participants in the country, as well as retain the public confidence in the financial system. So the financial sector reforms, the meaning of financial sector reform is to the aim of this financial sector reforms is to increase the soundness and the efficacy or efficiency of the existing financial system, remove the drawbacks of the financial system, and maintain this public confidence or public confidence in the financial system, and also provide promote financial stability. So the various financial reforms are suggestion to convert as a company. So the governmental institutions like government bodies like Life Insurance Corporation of India, then SBA, State Bank of India, etc. This commission, there is a commission for this financial sector reforms, and they are suggested to convert the institution like LIC, State Bank of India, etc. Suggestion to convert this as a company. Okay. Then recommendation of regulatory bodies, the commission recommended to establish regulatory bodies for strengthening these financial sectors, and also constitution of monetary policy committee under the finance ministry. And there is another term known as financial inclusion. There is another term known as financial inclusion. What do you mean by this financial inclusion? So financial inclusion means equality. Equality in the or financial inclusion means that individuals and business have access to useful and affordable financial products and services that meet their needs. There should be an equality in the availability of financial facilities to each and every human beings or every people in the society. So this is the importance of this financial inclusion. So these are the different finance sector reforms. First one was suggestion to convert as a company, like government bodies like Life Insurance Corporation, State Bank of India. The committee constituted under the finance sector reforms suggest them to convert as a company, and recommendation by regulatory bodies, and as well as the constitution of monetary policy committee set up by the finance ministry. And also there is another drastic change is known as financial inclusion. It means the availability or equal availability of opportunities to access the financial services. There are so many financial services provided by different institutions. Some of the peoples have directly access to financial services, and some of the peoples doesn't have a direct access to the financial services due to some factors. Financial inclusion means the equal availability of financial resources to each and every sectors or each and every peoples or society or peoples in the society. So this is known as financial inclusion. So some few questions are there. The first development financial institution was there's three options, four options: IDBI, IFCA, ICICI, and UTI. Okay, so not it is not UT, it's UTI. Okay. The first development financial institution was the option is option B. IFCA is the first financial institution. So the another question: which one of the following is the main objective of Unit Trust of India? Which of the following is the main objective of this Unit Trust of India? There are four options: to mobilize the savings of high income groups, to mobilize the savings of low and high income groups, to mobilize the savings of corporates, to mobilize the savings of low and middle income groups. The right option is option D, because UTA is a mutual fund agency. Its main purpose is to collect the savings of low and middle income groups. So the option D is the right answer. So consider the following statements regarding mutual funds. There are two statements are there, and answer codes are given. Uh, consider the following statements regarding mutual funds. Sorry. So two segments are there. Mutual funds can participate in options trading and carrying forward transaction securities. The second statement is mutual funds can invest in transferable securities in the money and capital markets. So there are two statements. Mutual funds can participate in options trading and carrying forward transaction securities. Number two, mutual funds can invest in transferable securities in the money as well as capital markets. So which of the statement or statements given above is or are correct? Option A, only one. Option B, only two. Option C, both one and two. Option D, neither one nor two. So the answer is option B, only two. Mutual funds can invest in transferable securities in the money and capital markets. So this is the right answer. So next question, mutual funds needs to calculate NAV, net annual value, for each calendar dash for their liquid fund schemes and plans. Mutual fund need to calculate net asset value for each calendar dash for their liquid fund schemes and plans. Options are day, week, month, and year. Four options are there: day, week, month, and year. The right option is option A. It will calculate a net asset value for each calendar day for their liquid fund schemes and plans. So another area under this financial institution, banking and financial institution, is financial regulators in India. Financial regulators in India. So in this phase, we have to thoroughly understand about the Securities and Exchange Board of India. Securities and Exchange Board of India. So what do you mean by this SEBI, or Security and Exchange Board of India? So SEBI was enacted or established under the Act of SEBI Act 1992. It main purpose of SEBI is to regulate the stock market movements in a country. Stock market movements in a country, and they issue rules, frameworks, and guidelines for the various primary as well as secondary markets, market intermediaries. and it helps in the efficient mobilization and allocation of resources through this securities market. And it's a regulatory authority on capital and derivative market in India. In order to control the financial markets, there is an apex institution known as SEBI, Securities and Exchange Board of India. It provides protection to investors from these fraudulent activities engaged in this securities market, and they controls or monitor the registering and as well as regulate the working of depository participants. And there are various venture capital funds available in a country. The main purpose of Securities and Exchange Board of India is to register and regulate the working of venture capital funds. They prohibit the insider trading and other speculative transactions, unhealthy speculative transactions in the stock markets. They call for information regarding the different documents of this different financial institution registered in India. And the main purpose of Securities and Exchange Board of India is to protect the investors' interest as well as promote the investors' education, as well as promote the investors' education. Okay. Hope the screen is visible.
Yes, sir.
Yeah, okay, fine. Okay, fine. So the apex financial institution or regulator of stock market transaction this primary as well as secondary market is Securities and Exchange Board of India. It established under the Act of SEBI Act 1992. It's a regulatory authority on capital as well as derivative markets in India. The purpose of Securities and Exchange Board of India is to protect the investors and also promote the investors' education relating to different financial systems or different the parts of this financial system and different financial instruments offered by the capital as well as secondary primary as well as secondary markets. Okay, and also money market as well as capital market. And there are various functions of this Securities and Exchange Board of India. The few of them were regulating the business of this derivative market in India, or regulatory authority on capital as well as derivative markets in India. Then it monitor the register. It helps in the registering and regulating the working of depository participants and also foreign exchange institutions, foreign institutional investors. Then also credit rating agencies. Then it also the measures referred to therein may provide for registering and regulating the working of venture capital funds and promoting and regulating self-regulatory organizations. It prohibit the fraudulent activities in the stock market or share trading activities. Then promote investors education and training, and also training of intermediaries of stock market. Prohibit insider trading and other unhealthy speculative transactions in the stock market. And they calling for information from or undertaking inspection, conducting inquiries of and audits of different stock exchanges, mutual fund agencies, then other persons associated with the securities market. They have the right to call any information from these depository participants and other financial institutions, and protect the investors from fraudulent activities and promote the investors education as well as training to financial intermediaries. So these are the most important functions of this Securities and Exchange Board of India. And they give powers to compel a listing of securities. And in case of any default from this financial institution about their functioning, the Securities and Exchange Board of India have the power to levy fees and fines. They grant approval to different bylaws of different financial institutions relating to this securities market, and registering and regulating the working of venture capital funds in a country, or venture capital funds in India. So these are the different functions of this Securities and Exchange Board of India. They act as the regulatory authority on capital as well as derivative markets in India. They protect the investors as well as promote the investors' education. they calling for information from information about statements or audited account figures of different stock exchanges, venture capital agencies, mutual fund agencies, etc. They prohibit in insider trading and other type of unhealthy speculative transactions. Then promoting investors education and registering and regulating the working of depositories, depository participants, mutual fund agencies, and then foreign institutional investors, and also credit rating agencies. They also have the power to compel listing of securities of different companies, and they have the power to levy fees and fines whenever in the case of default from the side of this various financial intermediaries or institutions. They grant approval to different bylaws of different financial institutions relating to this securities market, and they help in the registering and regulating the working of venture capital funds in India. Okay. So another area under this banking and financial institution is it is familiar to you, digitization of banking and other financial services. Digitization of banking and other financial services. So digitization means the recent trends in banking sector or financial sector or finance service sector. The most important one is e-banking or electronic banking. It is simply the use of electronic means to transfer funds directly from one account to another or one branch to another. So this is known as e-banking. All of you familiar about that. Then internet banking, the banking through websites. The bank may offer its customers online access to online access to account information, then payment of fund transfer facilities, also etc. etc. So this is known as internet banking. Automated teller machines are there. ATM card is also a debit card, and mobile banking. Suppose example Yono SBI. Then these are the different apps provided by different banks. So we can use these banking facilities through our own cell phones or mobile phones. Then smart cards. There is a electronic chip enabled card is there. Smart card used for these transactions. Then electronic check is there instead of this physical form of check. Electronic check is there. Then electronic clearing services, electronic clearing services. So electronic clearing service or ECS, it's a retail funds transfer system to effect payments like utility bills, like electricity bill, water bills, etc., etc. Then also dividend interest, collecting dividend interest, etc. This is known as electronic clearing services. Then RTGS and NEFT, real-time gross settlement as well as national electronic fund transfer. Then another term is known as core banking solution. What do you mean by this core banking solution or CBS? So the core banking solutions helped the banks to offer better customer service. So nowadays, service marketing is there. Customer service is the most important thing of this various banking and financial services. So the core banking solution means to offer better customer services, effective communication facilities between the customers as well as these financial institutions, and a good information technology. So all of these are familiar. So that's why I'm not explaining in detail due to this limited time. So digitization, under this digitization of banking and other finance services, we are studying the recent trends in the financial sectors or finance services and banking. Then e-banking, internet banking, ATMs, mobile banking, smart card enabled banking, credit cards. Credit cards are there. Then e-check, electronic clearing services, real-time gross settlement as well as national electronic fund transfer. Then core banking solution for better customer services. Core banking solutions are there. So these are the terms comes under the digitization of banking and other financial services. So another most important area you have to study is insurance. Insurance is directly related to risk. So the chance of risk is there. So we have to mitigate the chance of risk. So there is the importance of this term insurance. The importance of this term insurance. Okay. Just a minute. So insurance. What do you mean by this insurance? Insurance simply means it's a protection against possible eventual loss of goods or life. So we are insuring our life as well as our goods or cattle, houses, etc., etc. In order to get a protection against the possible eventual loss of goods or life, we are taking the insurance policy. So insurance is a form of contract. Insurance is a form of contract which provides protection against the possible eventual loss of goods or fire. So it's an arrangement by which the insurer undertakes. There is two persons are there, insurer as well as insured. The insurer undertakes to cover risk by providing compensation for specific losses, then damages, illness or death in return for payment of a specified premium. So three terms are important: insurer, insured, and premium. So insurer is a company who undertakes this insurance agreement. That's insurance contract. That's known as insurer. Insurer undertakes to cover the risk by providing compensation for a specified loss. Specified loss. Actually, this is an agreement or contract. So that's known as specified. So that's why I said that specified loss. Specified loss, damage, illness, or death in return for a payment of a specified premium. So the eventual possible loss are there. So suppose, for example, I am insuring my life. So life is unpredictable. Future is unpredictable. So that's why I am insuring my life for this from this insurance companies. And in the case of anything happens to me, I am an earning member in my family, and if anything happens to me physically, it will affect my family. So that's why I would like to take an insurance policy which cover my life. So that is a life insurance. And I have a motorcycle, and the chance of collisions are more. So that's why I take a motor vehicle insurance. And I have a godown full of different goods stored there. So chance of loss by fire or short circuits are there. So chance of loss are there. So I have to mitigate the chance of loss or loss arising from these risks. So that's why I'm taking an insurance policy. So insurance is a contract between insurer and insured to get a protection against the possible eventual loss of goods or life. So here the insurer undertakes to cover the risk by providing compensation for specified loss, damage, illness, or death in return for a payment. I have to pay a fixed payment known as specified premium. So, but the loss will be compensated as per the terms of agreement. So there is a contract. So that's why there will have an agreement. So as per the terms of agreement only, I have to get my compensation for my loss. And different parties are there. The first party is insurer, the agency or the company or the firm who insures the risk, who insures the risk is known as the insurer. Who is known as insured? He's the person who gets his life or property insured. That is known as insured. Then insurable interest means the subject matter for which type of risk I have to insure about a particular thing. That's insurable interest. And also there is a term known as surrender value. The surrender value means it is the amount received by the policy holder in case of terminating before maturity. So I am terminating my insurance before maturity date. So I get an amount known as surrender value. So another term known as assurance. Assurance is the term used in the case of death claims. Assurance is used in the case of death claims. So death is a certain risk. So that's why the if an insured purchases the life insurance, if anything happens to him, it's known as anything happens to him, get a compensation known as assurance. Assurance is a term used for death claims. Because actually I am taking a life insurance policy. I have died because of some reasons. I didn't get this compensation because I am not existing. The only the beneficiary or nominee gets this amount. So that's known as assurance. Okay, assurance is possible in the case of death insurance or life insurance only. So different types of insurance are there. This is the most important area. First one is life insurance. Life insurance is simply means related to human life. I have to pay a payment of lump sum money, and there is also insurer. Okay, like last slide, insurer as well as there insured, insurable interest and surrender value and assurance is there. It is applicable to any insurances. Okay, the types of insurance. First insurance is life insurance related to human life for a payment of a lump sum money. So what are the consent? So what are the elements of a life insurance contract? What are the elements of a life insurance contract? Just a minute. So what are the different elements of a life insurance contract? I'm going very speedily because of limited time. Sorry. Then free consent. There must be a free consent of the parties who are entering in the agreement should enter their free consent, and the parties engaged in this insurance contract must be legally competent, a person of sound mind, and physically fit also. Then some legal considerations are there. Each party must go through these legal considerations, and the certainty. That certainty means the terms and the conditions of the contract must be clearly stated. So that's not a certainty. The insurance contract will be according to or must follow the legal formalities, and there is a principle known as principle of utmost good faith. Both of the parties must have a trust or faith upon each other. Both the insured as well as insurer have a faith on each other. And there is a term known as proximate cause. There should be a reasonable cause. Then only we get a compensation. And there is a nomination facilities there. In the case of life insurance, if anything happens to me, I didn't get the amount because I am not existing. So my beneficiary will get the amount. So I have to fill a column known as a beneficiary or a nomination or a nominee. So these are the different elements of life insurance contract. Another insurance is non-life insurance. There are two types of insurance are there: life insurance as well as non-life insurance. Life insurance related to the human life, and general insurance is known as non-life insurance. First one is social welfare insurance. It provides social security to weaker sections and dependent or unproductive sections of society. The various schemes come under the social welfare insurance is pension schemes, unemployment allowances, old age allowances, natural calamities. These are not comes under the category of life insurance, so that's why it is known as general or non-life insurance. The name is social welfare insurance. So the main purpose is to protect the social welfare or provide social security to the weaker sections of the society as well as unproductive sections of the society, provide pension schemes, unemployment allowances, old age allowances, as well as if there is a natural calamities, that losses comes under the category of the social welfare insurance. So another non-life insurance is mortgage insurance. Mortgage insurance, all of you know that what do you mean by mortgage? I am not explaining that. Mortgage insurance compensates lenders or investors for losses due to the default of a mortgage loan. If there is a mortgage loan is there, if in the case of default from the side of both the parties or any of the parties, there is insurance known as a mortgage insurance. If borrowers are unable to repay the mortgages, the losses due to the investor or lenders or investors may come under this mortgage insurance scheme. Then another insurance is fire insurance. I am investing in this insurance because of this loss or damage due to this fire. It is normally it is a 1 year policy, and we have to renew from time to time. And there is a clause known as average clause. Suppose there are two amounts are there. Insured amount is much lesser than the actual loss, so the average clause is applied. Okay, so the average clause is applied in the case of fire insurance. Then another insurance is marine insurance. In the case of exporting and importing transaction, there is a marine, ships, these vessels, etc., etc. This is marine insurance to pay or loss damage by not fire. Okay. Then usually the period is 1 year, and we have to renew from this time to time. And there is a clause known as average clause. Average clause is applied. Sorry. Not average plus in the case of marine. So other types of insurances are there: motor vehicle insurance, then burglary insurance, then cattle insurance. These are the different types of other insurances not comes under the above said insurance policy. Then this another facility is known as a reinsurance. Reinsurance is a form of contract between the original insurer agrees to transfer a part of his risk to another insurance company. This is known as a reinsurance to reduce the financial cost. And also for transferring a part of risk, the reinsurance policy is there. So reinsurance is a contract between two insurance companies, not insured and insurer, two insurance companies. Then original insurer agrees to transfer a part of his risk to another insurance company, and also to reduce the financial cost or burden one insurance company. There must be a contract between two or more insurance companies. This is known as reinsurance. So risk classification, there are four types of risks are there. Then first one is financial and non-financial risk. Financial and non-financial risk. Financial risk are related to the material damage, theft or theft of property, personal injuries, and also profit, etc. These are financial risk, and the non-financial risk are related to other than these financial matters, like risks are choice of a vehicle, then selection of a particular thing, and career selection, etc. These risks are known as non-financial risk. When the risks are losses can be assessed for in a proper monetary value, it's known as financial, and otherwise it's known as non-financial risk. Then pure risk and speculative risk. Anticipated risk are known as pure risk. It happens. The speculative risk we cannot mention the future, mention about the future. So that's why speculative risk, chance of loss are there. Maybe chance of loss or not in a situation of this loss. So that is speculative risk. So the speculative risk is a category of risk that can be taken and voluntarily either result in profit or loss. Okay. Then systematic, fundamental and particular risk. Fundamental risks are those risks affects the common peoples like earthquake, tsunami, famine, drought, etc. These fundamental risks. Particular risk means a risk affected to or a particular risk are opposite to what has been narrated here before, because it is opposite of this fundamental risk. Particular risk usually arise from actions of individual or even group of individuals. This is known as particular risk. Systematic as well as unsystematic risk is there. Systematic as well as unsystematic risk is there. Then risk affecting a particular industry known as systematic industry, unsystematic risk, and when the risk happens to entire economy, it's known as systematic risk. So the factors limiting the insurability of risk are insurable as well as uninsurable risk, then premium loading and a parameter uncertainty. So I'm not explaining because of time management. So the risk management is there. Three processes in risk management. First one is risk assessment analysis, then risk evaluation, and risk treatment and response. So the risk assessment means the first step of risk management is risk assessment. Assessment helps to evaluate the organization's exposure to uncertain events. Then the second process is second thing is risk evaluation. Assessing After assessing and analyzing the risk, the next step is risk evaluation. Estimated risk are compared against the established risk criteria, and thereafter we have to treat the risk and take necessary measures for these risks. So these are known as risk management. So factors limiting the insurability risk are insurable risk as well as uninsurable risk. What do you mean with this insurable risk? Uh, which categories of risks are covered by the insurance company is known as insurable risk, and the company which not the risk which not covers under the insurance company is known as uninsurable risk. There are two terms are there: premium loading as well as parameter uncertainty. The premium loading means additional premium because suppose I have a physical, I would like to take a life insurance policy, but my health condition is very weak. So I have to take a policy which having additional premium. That's a premium loading. Then parameter uncertainty. There are some terms and conditions in case of this insurance. When it is not ended or lack of reasonable knowledge about these terms and conditions is known as parameter uncertain. So these are the some limits of this insurability of risk. And risk management, three processes are there: risk assessment, risk evaluation, and risk treatment. So the final topic is IRDA, Insurance Regulatory Development Authority of India. In order to protect the investors' interest from these insurance companies, as well as regulating the insurance companies, there is an agency known as Insurance Regulatory Development Authority of India. So the IRDA start. Hello, am I audible?
Yes, sir.
Oh, okay, okay. So IRDA comes under the IRDA Act 1999. It's an act of Parliament passed by the government of India. The different functions of Insurance Regulatory Development Authority of India are issuing, renewing, modifying, issuing, renewing, and modifying or suspending the registrations of different insurance organizations or companies, protecting the insurance policy holders' interest, and also educating the policy holders, and promoting the efficiency in the conduct of insurance business in a particular country or in India. And there are so many insurance agencies are there. So we have to regulate these insurance agencies. So there must be an apex institution for that. That institution is known as IRDA, and it will levy fees and other charges in the case of any defaults. It levy fees and other charges in the case of any default from this side of these insurance corporations or insurance companies. Okay, this is IRDAI. So this is an apex institution for meant for this controlling and maintaining this insurance sectors in a particular country. It protects the policyholders' interest from fraudulent activities from these insurance different insurance businesses, and promoting and systematic flow or promoting efficiency in the conduct of insurance businesses in India. And they regulate the insurance various insurance businesses registered in India. They levy fees and other charges in the case of any defaults. They are regulating very another they are regulating companies which engage in the investment of funds. Then in the case of any disputes between the insured and insurance companies, there is a dispute settlement mechanism is there. They supervise the tariff advisory committee and promoting efficiency in the conduct of insurance business in a country. There must be a code of conduct for the surveys as well as the laws of ethics. Okay, they must follow the code of conduct, and also issuing, renewing, modifying, withdrawing, and suspending or canceling the registration of any insurance corporations. So these are the different functions of Insurance Regulatory and Development Authority of India. So I am revising once more. Due to this time limit, I didn't explain the some of the terms. I know that because only 1.5 hours are there, so that's why. And our topic was financial institutions and intermediaries. So I started this slide with an overview of these financial institutions or financial systems. The overview of financial systems, we discussed about financial assets, both short term as well as long term. In the case of financial markets, the markets are classified into money market, which is the maturity period less than 1 year, and capital market instruments with maturity more than 1 year. Then financial institutions and intermediaries are broadly classified into two categories: organized as well as unorganized sectors. There are four different categories of this financial institution: development financial institution, non-banking financial companies, mutual funds, and pension funds. We discussed it earlier. So discuss some MCQs. Then financial sector reforms, we discussed about SEBI, digitization of different banking services we discussed, and discussed about insurance, different types of insurance, and also Apex Insurance Authority, IRDAI, and also we discussed about this risk management. So thank you for the participation.
Thank you, sir. It was an interesting session. If you have any doubt, you can ask. any doubts or questions? Class and giving awareness about financial institutions and intermediaries. Thank you, sir.
Good evening. Shall I start the class?
Now let's move on to the next session on consumer behavior logistics management taken by Dr. Jency S, PDF scholar of University of Kerala. Her PhD topic was Economic Empowerment through Financing Decision of NBFCs, a study on microenterprise. And her postdoctoral fellowship topic is Risk Management Practice in Banking Industry. It's my pleasure to welcome Dr. Jency ma'am to talk on consumer behavior logistics management. Ma'am, please. Not audible.
Hello, ma'am.
Ma'am, please unmute the mic.
ഓ സോറി, ഇത്രയും നേരം പറഞ്ഞതപ്പോ കേട്ടില്ല അല്ലേ?
No, ma'am.
ഓക്കെ ഓക്കെ, ഞാൻ കുറച്ച് എടുത്തായിരുന്നു. ഓക്കെ, ഇപ്പൊ കേൾക്കാൻ പറ്റുന്നുണ്ടല്ലേ? ഇപ്പൊ കേൾക്കാവോ?
Yes, ma'am. Yes, ma'am.
ഓക്കെ ഓക്കെ ഓക്കെ. Okay, my topic is today going to teach the marketing management in this certain portions, consumer behavior, and then logistic management, then recent trends in marketing. These topics are going to take. If any problem hearing, please inform me. So consumer behavior. All you have heard about the term consumer behavior now. Consumer behavior. It is the analysis of how consumers make decisions about what to buy, when to buy it, and how to do so. The consumer behavior. That's a consumer behavior. Every marketer must understand the consumer behavior. Then only they can take decisions about which product they have to buy and so on. And then the consumer behavior starts from the initial decisions when a consumer decide to buy it. From that point also the consumer behavior starts. Because consumer behavior includes everything from the initial decision to buy it to how they use it and whether or not they continue to purchase in the future. Only then the marketers, if the marketers only know the consumer behavior only, they can take any decisions to whether which product they to offer. So understanding consumer behavior is important for businesses because it can help them to make better decision of after knowing it, they can consider which product they have to be produced and so. It includes the study of this consumer. Hello, that
Slide
is
is not
clear.
visible.
No, and it includes the study of what they buy. In this consumer behavior, what all decisions came in, it's whether we decide what product they have to buy, why they buy it, when they buy it. All this come under the consumer behavior. Next, types of consumer behavior. This is an important topic, so please listen. Types of consumer behavior, 4 types: complex buying behavior, habitual buying behavior, variety seeking buying behavior, dissonance reducing buying behavior. First one is complex buying behavior. Before this telling, I will tell an example. If suppose you are going to buy a car. If a car means you know that we purchase this car or rarely, and those items are expensive. Think the terms, this expensive items and we are purchasing rarely. Example, car, then constructions of a building, these all come under in this category, complex buying behavior. This type of buying behavior is usually found in case of those products which are purchased rarely and the product is risky and expensive. When the consumer has high involvement, the consumer, in this case, when we are going to buy a car, we may what do? First search for information about the brand, then evaluate brand characteristics and make a decisions about which brand to buy. Before such a product is bought, that is before we buying a car, the consumer uses many criteria. No, if you are going to buy a car, we may consider what all criteria. We can first look, the evaluate the alternative brand and substitute product and spend much time in seeking information and determining on the purchase. We do not simply go and buy a car. First, we all search the information about the brand, then only buy it. This type of behavior is called the complex buying behavior. Second, the complex behavior in case of risky items or expensive items and which we purchase rarely. Next, habitual buying behavior. It occurs when the consumer makes purchases without much thought or effort. Here also I will tell an example in case of a salt. We know that salt is a less expensive item. We do not search for brand. Is it whether we go to shop and simply buy a salt. We do not make evaluation about which brand we had to bought. Okay. I mean, if I take an example, salt. Consumer have little involvement in this product category. They simply go to the store and search for a brand. If they keep reaching for the same brand, it is out of the habit rather than strong brand loyalty. We simply second time go and purchase, simply take. Not because of brand loyalty we are going to and purchasing it. This type of behavior is usually found in case of the frequently purchased and low-cost items. Note the term, in this habitual buying behavior, items came as frequently purchased and low-cost items. In this case, the habitual buying behavior comes. And the third one is variety-seeking buying behavior. It occurs when the consumer is looking for new experiences and seeks variety in their purchases. If I take an example of biscuit, if you are going to buy a biscuit, a consumer may hold some beliefs. So choose a biscuit brand without much evaluation. We do not make much evaluation. And then evaluate that brand during consumption. If we are going to buy a biscuit and during the consumption time, we will evaluate that brand. But the next time, the consumer might pick another brand out of it. If we are going to buy a biscuit, first time you will buy one brand. Next time we will go and take another biscuit because with that you will use the symbol and border. You will try about different things. Here comes the variety seeking buying behavior. Next one is dissonance reducing buying behavior. It occurs when the consumer experiences dissonance or delay after the purchase, such as buying a new phone or laptop. In this case, the limited, it is also known, this dissonance reducing buying behavior is also known as limited buying behavior. It is found when the consumer makes less frequent purchases involving huge investment. In this buying behavior, the consumer should gather information about all possible brands. For example, if we are going to purchase a phone, what will we look? We will gather all the information about that phone. And some amount of mental process will follow to arrive at such a decision. In this case, if you are going to buy a television, buying a television, the consumers examine various models and brands and make casual inquiries with the neighboring owners and discuss with family members before making a final decision. So before buying a decision, we will make an analysis, then only take it. There will be some gap. When after taking the decision to buy the phone, there will be some gap because we are searching for the information. In this case, dissonance reducing buying behavior. Okay.
മാം സ്ക്രീന് കാണുന്നില്ലേ?
കാണുന്നില്ലേ? ഒരു
ഇല്ല
മിനിറ്റ്.
മാം സ്ക്രീന് ഷെയർ ചെയ്യണില്ലേ?
ഓക്കെ, വന്നിട്ടില്ലായിരുന്നു. കാണുന്നുണ്ടോ?
Yes, ma'am.
ഓക്കെ. നെക്സ്റ്റ് ടോപ്പിക് ഈസ് കൺസ്യൂമർ ബൈയിങ് പ്രോസസ്. അപ്പൊ നമ്മൾ ഇത്രയും നേരം കൺസ്യൂമർ ബിഹേവിയർ ആണ് നോക്കിയത്. നെക്സ്റ്റ് ടോപ്പിക് ഈസ് കൺസ്യൂമർ ബൈയിങ് പ്രോസസ്. Consumer buying process. It consists of sequential steps. It means that this consumer buying process means that here we consider the steps that is followed after arriving the final decisions. This means the steps that follow to buy a final buying decisions. So marketers must know how the consumers reach the final decisions to buy the product. According to Philip Kotler, he proposed the 5 stages, 5 buying process. That is as follows under. One is problem recognition. Second one is information search. Third one is alternate evaluation. Fourth one is purchase decision. And at last, post-purchase behavior. First step is problem recognition. The first step of the consumer decision process is recognizing the need for a product. So if the consumer identify the want, then they need to gather the information to understand how they can fulfill that want. First, we have to identify our want. Then we will look at how this want can be achieved. So first stage is problem recognition. Then second one is information search. The interested consumers, after identifying our want, then the interested consumer will try to seek information. Now he will read newspapers, magazine, watch television, may visit the showroom or contact their salesman, or may discuss with their friends and relatives, and through they find all the possible sources of information. They can also, through personal sources, they can contact their family members, friends, package, relatives, and from that they get information, or through commercial sources, that is through advertising or package, trade show, display, they get the information. And through public sources like TV, newspaper, magazines, through they will get the information. So what was the first step was, we have to identify our need, then we have to collect the information. Third one is alternative evaluation. Earlier we looked at the consumer collected the information about certain brand. Now he undergoes the evaluation of brand. He cannot buy all of them. Normally he select the best one from that. The brand that offer maximum, he will select the brand that offer maximum satisfaction. Hence, he evaluate the competitive brands to judge which one is the best, the most attractive. And from that, he will select it. First, he will select the alternatives. So while we are evaluating the alternatives, certain criteria has to be followed. That is the benefit offered by the brand, or quality, selling price, and popularity or reputation of brand. These all to be considered while evaluating an alternative. After evaluating the alternative, what we had to next do? We had to make a purchase decision. That is, we had to make an actual purchase. This is the stage when the consumer prefers the most promising brand out of the several brands. Earlier, we have evaluate the brand, and from that brand, we have to select any one. That is the which provide maximum satisfaction. After purchase, make a purchase, what we have to next one step is post-purchase evaluation. The consumer, we all have certain expectation. No, we have the certain expectations. Before selecting a brand, we have certain expectations about that product, about that satisfaction. So he decides very systematically. There is no guarantee of a complete satisfaction. No, we do not get the complete satisfaction. No. There is always a possibility of variation between the expected level of satisfaction and actual satisfaction. So in this case, the marketer should monitor the post-purchase experience. So The market is the duty of the market to identify the post-purchase. They can do the contact the consumers and ask about the satisfaction. Now, these are the consumer buying process. What all? First one is problem recognition. Second one is information search. Third one is alternative evaluations. Fourth one is purchase decision. Next one is post-purchase evaluation. Here are the factors influencing consumer behavior. You all are familiar with this terms, just I am giving a brief. Personal factors, consumer behavior affecting factors. Four factors are there: personal factors, psychological factors, cultural factors, social factors. First one is personal factors. In these factors include age and life cycle stage, occupation and financial status, lifestyle. We are familiar age and life cycle case. We know that age and over the life cycle stages, people uses different product. The people at different ages will have different tastes in food, clothes, furniture. In the case of occupation and financial stress, the financial condition of an individual. We know that the occupation, if a change in occupation, high occupied person may select the product in such a standard, and low occupied people may select the product in such level. The result also affect the consumer buying behavior. Next, the lifestyle, individual's way of leading his life. This also affect the consumer buying behavior. Some may have different lifestyle. So the consumer's lifestyle also affect the buying behavior. Next one is psychological factors. It includes the motivation. You know that consumers are influenced by motivation. Every consumers may have motivation. No? You know that according to Maslow, needs can be classified into physiological, security, social, esteem needs, and the self-actualization need. A customer tend to satisfy their needs on the basis of intensity or requirements of the needs. Next, perception. Perceptions also affect individual's perception also affect the consumer buying behavior. Whenever we see an advertisement or review, feedback, or promotion regarding a product, we form an image of that item. This understanding the customer's perception help the marketers position their product better than that of the competitors. Next one, learning. Learning also affect the consumer's buying behavior. When a person buys a product, the general tendency is to learn something about that product. It changes. This attitude changes. This learned behavior changes the consumer behavior, which maybe he gained from his past experience, or maybe after using that product in earlier. Next one is belief and attitude. That you all know that the belief and attitude, it also affect their behavior. So what the marketers need to understand this attitude, this belief and attitudes of the consumers. Next, third factor is cultural factors. Culture, all know that the culture means what? A set of rules, values that is common to the members of the society. Due to the diversity of cultures across the world, so we know that the different countries have different culture. Marketers, due to this diversity, marketers adopt different approaches and use variations in their marketing mix. If you're taking an example of McDonald's, whose majority of sales is coming from selling beef, but this may not be part of the Indian menu. Because what? Because what is the reason? Because cow is a sacred animal here. No. Next one is subculture. We know that every culture has its own set of subculture. No? These groups may have similar habit or behavior pattern or buying behavior on the basis of their age or religion or geographical location. So what the marketers need to understand the requirement of the subcultural group and adopt strategies like altering if we have to alter the product or promotion or package, whether we have to change the package, all depend on this subculture. Next one is social class. Social class, we know that where the social class can be classified into as upper class, upper middle class, and low class. Every social class prefer. In case of middle class, they prefer distinct product, different brand preference. Low middle class, or they have a different brand preference. No, this will also affect the consumer buying behavior. So marketers, what do they do? They have to look at the class and have to offer the product. The expensive brand target upper class. If the brand is expensive, they have to target which class? Upper class or upper middle class people. Next one is social factors. All know that social factors in this come a family. Another family. Family also affect the individual buying pattern. How family go through various life cycle stages. No, each stage create different demand. If we tell an example, the consumer demand of a bachelor are different from those of a newly married couple. Or if, for example, if a family with the children or no children, older couples may have different because the children have need their own dress and all. So family will affect the consumer buying behavior. Next is friends. Or we know that we will hear the suggestions of the friends. No, the friends' suggestions may be different from that of the family. So this also affect the consumer buying behavior. Then formal social group. And then, for example, a member of a formal social group like a Lions Club, Lottery Club, these all influence the individual's buying behavior. All this about the factors influencing the decisions. What all factors are there? Personal factors, psychological factors, cultural factors, social factors. And this all about the consumer behavior. And next the topic is recent trends in marketing. In this first one is service marketing. Here comes the marketing, the recent all trends about marketing. So here comes about 4 or 5 types. First one is service marketing. We all have read about the term service. No, here I am explaining the characteristics of the services. First one is what? Intangible product. All we know that services cannot be seen, tasted, smelled before purchase. Example, banking, insurance, this all comes under service category. Then second category is inseparability. The services we cannot separate it from their providers. No. Third one is no transfer of possession or ownership take place when services is sold, there is no ownership is transferred. No. Then we cannot store or transport the services. These four are the characteristics of the services. Next one is 7 P's of service marketing. This is 7 P's of service marketing, not the marketing mix. You all have to studied the marketing mix and the 7 P's. Here I am explaining the 7 P's of service marketing mix. First one is product. In case of services, we know that the product is intangible. Services cannot be owned. You cannot be an owner of a services. No. If we go to a restaurant, you cannot become the owner, but you can only the service. We can only attain the services provided by them. Then second one is pricing. First one is 7 P's of service marketing mix. First one is product. Second one is pricing. Pricing of the services is tougher than the pricing of goods. If you have to consult a doctor, you also have to be pay price. No, we also have to pay price like in the form of the payment of fee. Next, third one is place. Service providers have to give special thought to where the services would be provided. Example, a restaurant. In case of a restaurant is better in located in a busy place. In case of tourist places always, then tourist spots as a restaurant has to be placed in the tourist place. No. Next one is promotion. How well customers know whether certain product or services is available in the market. They have to decide which channel of promotion want to use. Service providers offering identical services such as airlines or banks and insurance companies invest heavily in advertising their services. Not only product advertisement is there, but also service advertisement also is there. The four elements what all was product, then pricing, place, promotion. Again, three more element is there. That is a people. People are a defining factor in a service delivery process, since service is inseparable from the person providing it. A restaurant is known, example, a restaurant is known for its food and service provided by its staff. Therefore, employing, training, and retaining the right set of people become important for the success of the service business. Not only the product is important, but also the staff in this people, that restaurant is also important. Next one, process. The system by which consumer receives the delivery of services. Example, if you want to book a hotel room, you go to traveling website and you will select the room of your choice. And after that, you may make payment and will have room the booked. Then check-in and check-out process is included. This is the process of service marketing. Next one is physical evidence. We know that services are intangible in nature. So most service providers strive to incorporate certain tangible elements into their offering in order to enhance the customer experience. Suppose if you take an admission in a college, then you look what kind of infrastructure are provided, how will labs and equipment. All we look like. If you're going to admission, then look the infrastructure facilities. No, in case of the both, like in case of product, in the the services also, we will look the physical evidence. All this about the 7 P's of the service marketing. Let us consider an example. These are the 7 P's of service marketing. Suppose we booked a room, then hotel room is our product. The price will vary. The place where the hotel is located is the place. Then people involved are managers, receptionists, etc. Then the process, how you booked the room, check-in process, check-out process. Then physical evidence is what kind of the infrastructure facilities are provided in the hotel. This is service marketing triangle. Look the triangle. In this triangle, we have 3 components, but a company, customers, and employees. When company interact with the employees, that is internal marketing. When company interact with customers, that is external marketing. When employees interact with customer, that is interacting marketing. Right? When a company interact with employees, that is internal marketing. When company interact with customer, that is external marketing. When employees interact with customer, that is interactive marketing. So, in order to make external marketing so stronger, we need to be stronger in where internal marketing. Suppose if you want to deliver the product to the customer, then the company should very clear about what kind of product they are producing, what kind of promotional strategy are using, or what price they have to be charged from the customers. If you clear with all this concept, then if you're internally stronger than only outside strong. Only strong internal marketing will have the strong external marketing. Next topic is social marketing. Social. That's a reason we are discussing the recent trends in marketing. We now looked about social service marketing. Second one is social marketing. Social marketing. It is an approach used to develop activities aimed at changing or maintaining people's behavior. for the benefit of individual and society as a whole. It is the marketing for the betterment of or benefit of the society. Here our aim is not the profit maximization. It is used mainly by the non-profit organization, charity foundations, and they all the public highway department. They all use this social marketing. We have to look. Our aim is not profit maximization. Where our aim is to change the behavior of our society. Our main motive is social welfare. For example, if we're looking the no smoking campaign, asking the people to use the seat belt, or campaign to reduce drunk driving behavior. This is all the example of the social marketing. While we looking that the profit maximization is not our aim. Our aim is social welfare. Social marketing aim to promote social benefit and not profit maximization. The benefits of social marketing. First one is promote environmental friendliness. Social marketing encourages the use and promote what we are promoting the consumption of socially disabled goods. So this is the goal for reducing the pollution. Second one is promote health consciences. As people get more aware and knowledgeable about taking care of their environment. So after hearing this social concept, we are all aware about the environment, and thereby we are more about health conscious. This allows people to adopt a healthier lifestyle. Third one is helps in green marketing initiatives. Social marketing promote initiatives related to the green marketing, like minimizing the energy wastages and all. Then helps in eradicating social evils. Understanding social marketing and working on it helps to reduce social evils. Then cost effective. And social marketing campaign are done using the latest development. Like we all know that now the social marketing campaign is done through the digital platforms like online. The cost incurred by them is comparatively lesser than other type of marketing strategies. These are the benefit of social marketing. Then where we can the applications where we can use the anti-tobacco campaign, anti-drug campaign, anti-pollution campaign, road safety, anti-dowry campaign, protection of girls child campaign, campaign against the use of plastic bag. These all come under the social marketing. Now this is very important. Social marketing, differences between social marketing and societal marketing. In social marketing, our main aim is social good. But in societal marketing, our main aim is profit generation. Then second one, in social marketing, our aim is to bring social change. But in societal marketing, our aim is to build goodwill among the customers. And third one is social marketing, as we already told that it is carried by government and non-government organization. But in case of societal marketing, it is carried by corporate houses and business firms. In examples, social marketing, we told that polio drop campaign, safe drive, these are the example of social marketing. In societal marketing, Surf Excel, whenever using this Surf Excel powder for washing the clothes, we all saw the advertisement, when we using the Surf Excel powder for powder, we can require only minimum water. But this is the primary, but their primary aim is what? Profit maximization. Then only the social welfare came. No, this is the main differences between social marketing and societal marketing. Next one, third one is online marketing. All are familiar with this term online marketing. It is also known as internet marketing. It is the way of marketing used in today's world for what? To draw customers' attention towards their product and services. They use various social media platforms, online channels, online platforms. Through that, they make the marketing. So simply we can say that online marketing is the art of selling product and services. How they sell the product? Through digital networks like internet or cell phone, cellular phone network. Next, types of online marketing. This is also important. First one is search engine optimization. This search engine optimization. This is used done to improve search engine ranking. I will tell an example. If you suppose you are doing a business of office furniture, if you want your office furniture website to appear at the top of the Google search result, when someone search for office furniture in London, then we can use this technique of search engine optimization. So it is done to improve the search engine ranking so that number of visitors to a particular web page can be maximized. The second one is social media marketing. Here we use social media app as a marketing tool. That is a process of securing the attention and sale. How we are attaining the attention through the use of social media platform. Or we know that social media platform like the Facebook, Instagram, or Twitter. The third one is content marketing. That use attract and retain customers. Create and share. As an example, a buy tool company right back trip. So they are creating a video in order to get more familiar with their customers' mind. They may either create video or blogs, newsletters, social media posts. This approach promote brand awareness and keep your business top of mind when it comes by when it's time to buy when you sell. So customers in first they will keep in mind about video that post. Next one is email marketing. All you have heard about the email marketing. Is that form of the digital marketing. Here we want to use emails to promote the business product or services so that the customers are familiar about the latest items, offers, or about the new products. Next one is influencer marketing. Influencer marketing. Here, influencers may be celebrities or expert or any YouTube channel owner. They are having the large number of followers. They may promote a company's product to their audience. Audience often through their platform. If a YouTube owner, they will familiarize a product through their channel or through Instagram or any Snapchat. By seeing this, the followers will listen their recommendation and buy that product. This is influencer marketing. Here, when celebrities or any actor or any YouTube owner, they may promote the product through showing that product through the channel. Thereby, the followers may buy purchase that product. This is influencer marketing. Next one is video marketing. Here, what we use videos. We use videos for promoting and telling people about product or service. Main purpose is educate the potential customers, existing customers about the benefit and the best practices of the product. Through these videos, they are well familiar about that product and so on. Next one is green marketing. Next type is green marketing. All you have heard green marketing smart. It is developing and selling environmental friendly goods or services. In this, green marketing practices include what all come under green marketing. It includes using recycled and renewable energy, renewable material for production. Second one, use of green energy to produce products such as solar energy or geothermal energy, wind energy. This all come under green marketing. Next one, reduce product packaging or we are whether using the eco-friendly packaging. This all come under green marketing. Next, you are not using toxic materials which are harmful to the environment. Then making products which are reusable as well as recyclable. This all come under green marketing practices. Next one is green marketing strategy. This is very important, so listen carefully. First one is green design. Design green products. This comes under design green products and services from the very beginning. That is, we are implementing the strategy during the planning and designing stages of the product. That is, we are starting the green product strategy at the initial stage of the product. One such example is a solar water heater, which can potentially decrease energy consumption by 70% just because of their design. Due to their initial design, they have saved 70% energy. That is green design. Next one is green positioning. Here, the company owns it substantially values, and they try to show itself as a company that cares. Example, the body shop company. They have never used the products on animals. So they have a trademark. Right? They have never used any animals. That is green positioning. Next one is green pricing. This strategy is used to make offering more attractive. Here our this strategy main aim is to highlight how green offering helps the consumer in saving money. An example, company which sells CNG car by highlighting how economical and how beneficial it would be on a CNG car when compared to petrol car. So they can know how it is a benefit, how much they can save. Next one is green logistics. It includes this green logistics includes all measures taken by the company to minimize the ecological impact of all logical activities that occur between the point of origin and point of consumption. And tell an example. Amazon uses one green logistic practices called frustration-free packaging. This frustration-free packaging, it is easy to open a recycling packaging which uses the packaging is less. That is, they do not use any wire ties, plastic bindings, etc. This is the green logistics. And last one is green disposal. We know that business have lot of waste materials. So this green disposal could be the perfect green marketing strategy for those business which have a lot of waste materials. Here, all the products or used materials have to be recycled. Okay. Next type is direct marketing. Direct marketing. We have that direct marketing means it is the form of marketing that focus on communicating directly to the customers or clients in order to promote the product or services. That is, here we eliminate the middleman. There is no middleman or advertising agencies. We are directly communicating to the customers. If I take an example, the company has the consumer details. If it is a promotion, we use that a promotion. So such companies, if a company has customer details, maybe from their previous sales, then such companies mail about their latest product or discount to that customers using that data. Next one is types of direct marketing. All you have heard about face-to-face marketing. Then this is a marketing channel where the company directly meet with the customers. The company assign a representative. They are required to meet the client. They explain about the product. So their main aim is to make a sale. Second one is door-to-door marketing. Here the team or agent to go door to door. It means they visit the people's home and engage in conversation. And then they're required to talk about their product. They help to make quick sales. They will explain the product and make the quick sale. Then the agent have to follow through every home and have to report the performance at last. Next one is kiosk marketing. Kiosk means a machine kept in the shopping mall. You have seen shopping mall or any other places, this machine is there to spread the information and generate order from customers. I will tell an example. In Ambipur, a perfume company dealing in room freshness organized their marketing campaign in Mumbai. The company used inflatables to attract small boys. It is also attracted by the parents and they got the information about it. The main objective of this campaign is to make awareness about the product. So when we go to a shopping mall, when we see this, we all get awareness about the new product. Next one is telemarketing. So all we know that the company staff, what do they will contact and call them and inform about their product. This is through the telephone. The next one is email marketing. Here the companies target customers and they send the mails. These mails have the details about the company and the product. They may also offer the discount through this email marketing. Next one is rural marketing. Next type, rural marketing. Here our main aim is to promote product in rural areas. This is usually done in areas where most people are engaged in agriculture and other related activities. An example, Amul. You all know that Amul company, they have conducted utterly butterly delicious campaign in rural areas. In this campaign, they created a cheap and localized product to meet the need of the rural people because they do not have much higher income than the urban area. So this through this rural marketing, how they can afford this cost. The market identify their rural customer requirement and supply goods and services according to their satisfaction. Here it is the main aim is to improve the rural consumer standard of living. Next, scope of the rural marketing. First one is agriculture. Rural consumers are involved. We know that the rural consumers are involved in various agriculture like farming, fisheries, animal husbandry. All the businesses can satisfy this rural clients' needs. How? By giving them needed agricultural input like fertilizers or is available, they can help the rural consumers. Next one is fast moving consumer goods. This fast moving consumer goods have very wider scope in rural market. Normally rural buyers, we know that rural buyers have lower income than the urban buyers. Fast moving consumer goods firms may create goods that satisfy the rural clients. They cannot be charging high price. If they charge high price, the rural consumers cannot afford it. An example, Hindustan Unilever and Nestle, they created affordable and localized goods like Sostu Bharat soap and Maggi Masala Magic, mainly for the rural buyers. They created this type of the product so that they can be afford this product. Next one is healthcare. Healthcare. Rural consumers often lack access to, they do not, because of less income, do not care about much health. This makes them vulnerable to various diseases. The companies can market affordable healthcare products like medicine, vaccines, and medical tools to these rural areas. Next one is education. We know that education is where the rural marketing has a very good scope. Firms can promote affordable education products like books, stationery, and other items to rural users. Also, they can provide the scholarship also can give to those students. Next one is 4 A's of rural marketing. One is affordability. Next one is availability. Then acceptability. Then awareness. First one is affordability. So this is important in the case of rural. This is the recent trends. Here 4 A's is considered. First one is affordability. Incomes in rural areas. We know that the rural areas income, the people in rural areas very lower income than cities. The consumers there often can't afford luxury items and they focus on the necessary product. They cannot afford the high luxury items. Example, Philips introduced the smokeless stove named Chulha for rural population. And second A is availability. Sometimes product may not be readily available in rural stores, due to which the consumers may shift to another substitute product. So the company should try to offer their product to customer sources. Example, the bike manufacturer Hero Honda has introduced servicing on wheels that make it easy for consumers to service their vehicles from the remote locations. Third one is acceptability. Product should be designed in a user-friendly way. The product should be designed in a user-friendly way to benefit the rural customers. The consumer should have a sense of comfort when using the product. For example, the Philips introduced a color television range named Vardhan, a customized television for rural market which works on low voltage. So everyone can afford that TV. Next one is awareness. Customers awareness campaign. This can be conducted. Companies can be conducted like commercial on TV, radio, outcast. This can be used. So these customers, the customer, rural consumers may aware about the product. These are the 4 A's of rural market. These are all about the recent trends in marketing. Next topic is customer relationship marketing, CRM. You all have heard the term customer relationship management. This is different. This is customer relationship marketing. It is a business process in which here came the client relationship. That is, it's a technique based on client relationship and customer loyalty using customer data and feedback. Company utilize this marketing strategy and develop the long-term relationship with the customers. Here, the companies give importance to the customer relationship. They try to create strong customer connections, sometimes which may be emotional, and sometimes they may be strongly attached to the product. Examples, you can thank the customers for their business through a social post or surprise gift card, or you can offer the discount and bonus so that the customers may repeat by purchasing the same product from the same company. This is also important. Types of customer relationship marketing. First one is basic CRM, that is basic relationship marketing. It is the traditional form of relationship marketing. That is, here our main aim is focus is to product, selling the product. That is, this is the form of direct selling. Here where there is no follow-up after purchase. Here we simply sell the product and there is no follow-up. That is, there is no further communication or feedback. It is just only for the making money. That is first one, basic CRM. Second one is reactive CRM. Here, after say, then the next step is to respond by asking the customers to provide feedback. Here, next step is also came where feedback also we obtain from the customers. Maybe it is complaint or comment or suggestion. There is some effort to build a relationship with the customer when the situation or opportunity arises. In first cases, in basic CRM, we just sell the product and there is no follow-up. But in case of reactive CRM, there is a feedback also is required. Next one is accountable CRM. It involves directly contacting the customer after a sales to confirm the product or service, whether they are satisfied with the product, we will contact them. Here they can ask the customer feedback and take the appropriate actions. This is accountable CRM. Next one is proactive CRM. It pays close attention to what people want and uses the customer data in order to understand their purchasing behavior. For example, Tyson Foods released a hunger relief campaign. The company promised to donate some of its food product according to customers' comment. With what all products are asked in their blog, they will offer it. Tyson Food get continuous feedback after using this campaign. That is proactive CRM. Next one is partnership CRM. Here the two business work together in a mutual beneficial way towards a common goal. It could be for a specific campaign, product, or set amount of time. This enables the companies to increase brand awareness and also to improve the sales. For example, a partnership between Microsoft and Nokia. Microsoft developed the Windows operating system that runs on Nokia Lumia devices. This is the strong relationship marketing between the two company, software and hardware company. This is partnership CRM. All clear about the topic? That is the customer relationship marketing. This is a little different from customer relationship management. Then last topic is logistic management. Logistic management. It is the acquisition, storage, and transportation of inventory from its origin to its destination. It includes all the steps between the origin till the final destinations. It ensures that the required goods reaches the right place, right time, and the right person. This starts from the origin of the goods until where it is reaches. These all steps include under the logistic management. Next one is scope of logistic management. This is important. First one is network design. It is one of the primary function performed by the process of logistic management. Here, the logistical manager properly design a network that denote the number and location of production plant, storage houses, equipment for handling business. These all include under the network design. Second one is procurement. Here we ensure that the correct raw materials and goods are procured on correct time. They must also reach the necessary, this product must reach the necessary department. It also ensures that the all required raw materials of right quality are provided at right time at a minimum cost. And third one is material handling. Safety handling manufacturing materials is very important, no? Where the product have to be safely handled. Those raw materials or semi-finished goods or final goods, these should be properly handled within and outside the manufacturing plant, or maybe within the outside the storage house or outside the transportation terminal. This couldn't be lost. This should not be broken down, or this should not be, and should not occur any loss or breakage. Next one is order processing. Here we ensure that all orders are timely processed and various receiving, handling of consumer orders, and so on. It focuses on what we are looking here is reducing the time gap and fast processing of the order. The main aim is very processing the order is the main aim. Then next one is inventory management. Here, the logistical manager ensure proper amount of inventory is maintained at every point of time, so that production may not be soft. So we should ensure the correct amount of inventory is there or not, and also ensure regular supply of goods to the consumer. Where overstocking, understocking of inventory is prevented and optimum amount is always maintained. This should be ensured under the logistic management. Next one is packaging. It is very important. It ensures the product have a safe transportation process. Next one is warehousing. It aims at safe storage of product during the time gap between from production time to consumption time. We all know that warehousing. Now, logistical managers properly decide number and location of all warehouses to be established by company for proper storage of its products. Next one is transportation. It creates time utility. How? By delivering the goods at right time and right order. The logistical manager choose a right source of transportation, whether they have to by railway or roadway or airway or waterway, by analyzing them in terms of their cost, speed, safer, and considering we can select the which way of can be used. Last topic is types of logistic management. This is very important. First one is supply chain management. It is the process of ordering and planning and receiving the raw materials that require urgent delivery. That is, which one is require very urgent. It is the processes, supply chain management. Also, it assesses whether supply is in accordance with demand in order to ensure that the process runs smoothly and is not disturbed. And we have to ensure whether the demand is the supply product supplied according to the demand. This all come under the supply chain management. Next one is distribution management. Here, here usually involves transporting stored materials or goods for further processing or for distribution. This process is very time consuming. What is the reason this is very time consuming? Because it involves loading, unloading items before they finally make it to the retail stores. There requires some sometimes because we have to load the items, we have to make the shipment, unload, then we have to specify the details of the store. All requires some time. So this in these cases there will be time considered, time factor should be considered. Then production management. Here we mix the raw materials and the different components, and after that only the final product will be occurred. To create the final product, we have to thoroughly search for the required material. So the manager should oversee these process and align the shipments within the production schedule, so as to can avoid any delay in this deadline. So we have to make the process very clear. Next one is reverse logistics and product return. Here, the unused raw material must be taken care also. This process helps in managing the product return, and also if there is any unwanted or any damage or unused product, we should carefully refund. Their main aim is the unused raw product must be taken care. That all comes under this reverse logistics and product return. These are the types of logistic management. Okay, thank you.
Thank you, ma'am, for giving awareness on consumer behavior and logistic management.
If you have any doubt, please ask me.
Thank you, ma'am.